All right, good morning. I hope you're doing well. Today I'm going to talk to you about how I lost 22% of my play money investment account that sits in Robinhood and what I could have done differently to keep from losing that 22%. Now, that 22% decline is since an all-time high in that account back in November. Now, I've had the whole account in Robinhood for over a year and a half. And the good news is even with my 22% decline, I'm still up 62% altogether. So I don't feel too terrible about it. But look back on this 22% decline that I've seen since November, and there's definitely some things I could have done differently. And I want to share some of those things with you today. I know I'm not alone. I'm not the only one that's felt this decline. If you look at the overall markets, there's definitely been a dip since this winter. Certainly some recent dips because of the war between Ukraine and Russia. And so it's just a challenging market. And when that happens, you have to alter your investment strategy. And I just didn't alter mine soon enough. So let me share with you a couple of the lessons that I've learned since that dip in November and what I think I could have done differently. Now, the first thing to share with you, although I definitely believe in studying the fundamentals of a particular stock, of the market, looking at data and information, I really feel like the biggest mistake I made was I just didn't trust my instincts enough. Back around this winter, prior to probably around Halloween, so late October in the United States, my gut just started telling me that valuations of individual stocks were just way too high. The PE ratios were way too high for most stocks, particularly tech stocks. I thought cryptos were looking a little too strong. Just in general, I felt like the market was a little overpriced. And while I was able to make some purchases and still make some money on paper of those investments, my gut was just telling me that it was a little too high and that we were going to see things come down. At the time, back in the winter, I don't think we knew that Russia was going to invade the Ukraine and that was going to further push the markets down. But I was feeling some tension, particularly around inflation, and was thinking that it was maybe time to alter my investment strategy. And I had multiple stocks that were at 52-week highs of their own, and so I just should have trusted my instincts that it was time to make a change to my overarching investment strategy. I didn't start looking into hedging some of these strategies until a couple of months ago, so I missed a couple of months where I really could have had some action. So just thinking about, trust your instincts, certainly support that with information, but when you feel like something is off, you need to dig further into that and trust what you're experiencing, especially if you've been a trader for a long time. The other thing that I think I made a mistake was just not being very diversified. Now, I alluded to this earlier. This is sort of what I call my play money account, just where I trade and I try not to worry too much about what's going on. I have other investment accounts that are taking care of us for retirement. This is sort of my just have a good time and learn and experiment account. Certainly no one wants to lose money though. Within this particular Robinhood account, I just don't think I was diversified enough. That's a sort of a normal practice for investors to be well diversified so that you don't see losses in one sector and hopefully other sectors aren't seeing as much of a loss, or other investments. And within this particular Robinhood account, it just wasn't very diversified. So it looks like if I look at my numbers, I had 48% of the balances as of today, actually. 48% of the balances are in ETFs, 41 in individual stocks, and 11% in various cryptos. I've got crypto investments in other places like a Coinbase account and things like that. But when you look at that 48% in ETFs, that is actually a more recent change. So back in November, you wouldn't have seen those ETFs at all. I was I would say probably 80, 90% in individual stocks and the other 11 to 15%, somewhere around there, in cryptos. So I was not very diversified back in November, and didn't start to move towards some better diversification until maybe 2 months ago. So definitely feel like I should have diversified a lot better. Another mistake I made in this investment account was it is where I had bought into various IPOs. So I own the Lucid IPO. I bought into the Coinbase IPO. I'm going to talk about that in a second. I bought into the Rivian IPO and the Nubank, which is a fintech company in Brazil. in the space that I know well, I bought into all of those IPOs. And candidly, I bought into some of the IPO hype. So Coinbase is the perfect example of where I made a mistake of falling for the hype. Coinbase, overall, I've lost money on that investment so far. Do I think it's going to come back around? Do I think Coinbase is a great opportunity? I do. That's why I still hold it. But I remember when I got given my individual allocation to buy into the IPO, gosh, I'm going off memory here, so don't quote me on this, but I want to say that it was $230 was the strike price, initial estimate of strike price at the IPO. And if I remember correctly, on the day of the IPO, we kept getting notification that the strike price was climbing because demand was so high for the Coinbase IPO. And I feel like I stayed in it until around $381 per share. That number sticks out in my head, so maybe it's accurate. Regardless of if the numbers are exactly accurate or not, the lesson I learned from that is I sort of started to feel a little icky about buying in once it started to cross well into the 300s. And so I had to keep canceling my order and reasserting my order at a higher strike price. And eventually toward the last couple of changes, I just kind of felt like maybe I should have waited. Again, I do still feel like it's a great investment, but if you look, had I waited, it would have IPO'd and then the stock price has come down. I could have bought in at a much lower stock price. So avoiding IPO hype is definitely another lesson I learned in the last couple of months. Got a couple more lessons for you, so just stick with me. The next one is taking your gains. So I've not been good at doing this either in that particular account. I mentioned earlier that I've had multiple stocks that I've been part of for a while that have risen to 52-week highs. They kind of hit those ceilings and then held right near them, maybe even came back down some. And on a few of them, I should have taken my gains and sort of gone with the saying that investors use, which is, well, let me back off that. I should have taken my gains. Investors talk about this idea of ride the winners. So sticking with winning stocks that you have invested in. And I do think that's a really good strategy overall, right? But I do think there are times, depending on the indicators and things that you're seeing and trends on a particular stock, that you should take your gains and leave it. Now, I used to do a lot better job of this. So there was a stock years ago. It's not performing anywhere near like this now, but a stock that I was invested in, I had bought into it when it was less than $1. So it was technically a penny stock, and it went all the way up to $6. And so what did I do? Boy, I sold out of it, completely out of it, and took my gains off the table. And then it dipped way back down to like $1, and I bought back in. So taking your gains is a great strategy. Some people hesitate to sell when a stock hits a height because they believe it's going to keep performing well, and that can be true. Sometimes the stock will split if it stays at a high too long. I've owned Apple for a while, or did own Apple for a while, and I owned it when it split. Actually, I still own Apple. I owned it when it split. So sometimes that does happen, but I do think it's not a bad strategy sometimes to take your gains and then sit on it. And in an environment like we just went through, where things hit a real high valuation, take those gains, watch them dip back down, and then you can buy back in at a lower price and maybe ride it back up if you think that's what's going to happen. So that was really my last point. I just made it, was that the idea you can always buy back in. That was another lesson that I sort of just held on for way too long. So one more example on this: Bitcoin hit its 52-week high, or its high, all-time high. I think it was $67,000, maybe in November. So it was high as well. And what I didn't do that I should have done was sell at that high, and I could have always bought back in at its lower valuation. That I think it sits around 41,000 at the time that I wrote this original post, and I'm now recording the video for you. So I recognize that a lot of what I'm suggesting to you involves timing. And I know that a lot of experts would tell you it's hard to time the market. I feel like I'm a little bit in a different situation than most of your average investors. I've got training in this industry. I've been in finance most of my professional career. Just feel like I have a little bit extra education and experience to be able to work around timing the markets. And so I feel a bit more comfortable trying to do that, especially in an account that I've set aside as play money that I'm willing to experiment with. So be careful trying to time the market. But I think these are some really great lessons to take away If you've had your own lessons, I'd love to see your comments below on the video. What did you learn as part of some of your investment strategies? What mistakes have you made? I'm trying to be candid with you here because I think this is a great opportunity for other people to learn from my mistakes. I'm not a perfect investor. I would tell you overall, I've done really well as an investor, but sometimes you do take these downturns. Granted, they're paper losses, right? So you really only lose when you sell. And I have not done any of that. But these are some good lessons for you to think about. As always, I have to tell you the disclaimer: this is not investment advice on what you should particularly do. I'm sharing with you my opinions and thoughts. You should always talk to a qualified investment professional before you do take any actions. But this is some things that I have learned, and I hope they help you as you think about your investment opportunities in the market. I'm looking at it. We're 30 minutes past the open, and it looks like the markets are down on the open just a little bit. Anyways, until next time, I hope that helps. Hope you find your voice. Have a great day.